Nvidia, TSMC, Amazon, and Eli Lilly. These are some of the companies that are having a profound impact on our lives and changing the world around us. But as investors, how can we best navigate this change? Today, I am speaking to an investor who has ridden this wave of disruption better than almost any other Australian investor.
They only take the best of the best.
The best investment by far is anything that develops yourself.
Welcome to the Best of the Best series on Equity Mates, brought to you by Viola Private Wealth. Over 6 episodes, we're speaking to some of Australia's best investors to understand how they approach markets and what we can learn from their processes. Today, I'm speaking to Anshu Sharma, portfolio manager and co-founder of Loftus Peak. Now, we've had Loftus Peak on the podcast before, and we always enjoy speaking to them. Partly, it's because their returns are pretty good. Their Loftus Peak Global Disruption Active ETFs has delivered 22% per year after fees since 2016 when it started. That's beaten the global stock market index by almost 8% a year. But it's not just the returns that make this conversation exciting. It's also the way they've delivered the returns and the companies that they're investing in. They invest in well-known companies on the cutting edge of disruption. We're talking about Nvidia leading this AI revolution, or Eli Lilly leading the market in GLP-1 weight loss drugs. A lot of us invest in these companies. A lot of us have seen these companies grow over time, but few of us have done as well as Loftus Peak. So that's what I want to dig into today, how Loftus Peak have ridden these waves of disruption better than most of the rest of us. So strap in. It's going to be a volatile ride. We're talking all things growth investing today. But before we get into it, I want to say a massive thank you to our series sponsor, Viola Private Wealth. Throughout this series, we've been hunting down the best fund managers in the game. And guess what? So are they. Viola manages over $2.5 billion by finding the best opportunities across public and private markets. Think of them as the talent scouts of the investment world. Find out more at violaprivatewealth.com.au. It is support from partners like Viola Private Wealth that help us keep all of our content free. Well, Anshu, welcome to Equity Mates.
Thanks for having me here.
I'm excited for this one. I'm sure we're going to talk about a lot of interesting companies, some that are well known to the audience, some maybe less well known. But I want to start with your philosophy, talk about your process, and then sort of get into how you're seeing the market today.
Sure.
So if we start at a really high level with your investment philosophy, what is the core philosophy that guides Loftus Peak and how you invest?
So our philosophy or the belief since 2014, there are 3 parts to it and pretty much chronological. First is our belief has been that disruption will roll through each and every industry in the world. So essentially that means it will become the bigger part of the market. Second one is as it rolls through each and every industry, there would be mispricing in the market because market won't be able to understand the magnitude of disruption. What I mean by that essentially is market tends to be very myopic in nature. And there's always anchoring bias. So a lot of times the way I put it is market wants to look at a crystal ball as if it's a mirror.
Okay, yeah, I like that, yeah.
Yeah. And then if we are right on the first and second belief, what we require is a process, a repeatable process to unearth, value, and risk adjust our portfolio. So a lot of our time has been spent on that point 3 over the last whole decade now in building that process. In terms of scorecard, if you try to understand these 3 philosophies, has disruption rolled through each and every industry in the world? At this point in time, the portfolio is invested in about 7 of the 11 MSCI-defined sectors. So disruption is rolling through all those industries. If you look at our performance, the alpha is quite decent.
Yeah.
That essentially means there was some mispricing in the market or there is some mispricing in the market, and hence the process is working.
Well, let's start with that first part of the philosophy, that disruption will roll through the market.
Yeah.
And disruption is something that a lot of people talk about, but
Yep.
I guess it's harder to really see where something is sort of long-term disruption and
Yep.
where something might be like a short-term trend or a fad. So how do you actually distinguish those 2 things and really focus on those like long-term structural changes?
Maybe there are 2 parts to this question, I think. One is the investment implications of long-term structural trend and short-term structural and a short-term trend. And then how do you differentiate between those two? So maybe I'll start from the easier part, which is differentiating between long-term and a short-term. Long-term trends don't happen overnight. right? There are a lot of data points which are available over the months, over the quarters, over the years prior to which they become mainstream. To give an example, back in 2014, when the founders of Loftus Peak came together, that was Alex, Rick, and me, we had 5 areas of interest, 5 areas which we wanted to focus on, which we thought is going to cover all the disruption which the world is about to see over the next whole decade. So in 14, we had a good body of knowledge before we started this firm. In 5 areas. 5 areas were networks and ecosystems, data centers, China by the virtue of its size, Internet of Things, and energy as a technology, energy as a technology, essentially. Yeah. So these were the 5 areas which we started with. And as the time progressed, month by month, quarter by quarter, year by year, we kept on adding to those areas. Every data point gave us an indication how close we are to this thing going mainstream. And the data points were like blogs, white papers, broker conferences, and then a lot of trade shows. So what Loftus loves to do a lot of time is we like going to trade shows where you don't find any investors. The places like Hot Chips, which we go to, it's pretty much all the PhDs there. Everything goes over our head. And we're just trying to understand what's going to happen next. Is it GPU? Is it CPU? What's happening on the memory side of things? You do get those data points. We go to CES, we go to CeBIT, we go to Mobile World Congress. We were in China last month. So we go to all these places where a lot of times you don't find investors to get those data points, looking into those 5 areas. So by the time these things become mainstream, you're very clear that you can invest in them now. What we want to do is be 12 to 18 months earlier than the market, get set, and let the market catch up to that. Short-term fads, I think that's a problem. A problem in terms of they don't have that liberty of time on our hands. A lot of times the short-term fads tend to be very company-specific, or they tend to be very niche and very time-specific. So that always creates an issue in terms of investments. But when it comes to investing, there are different implications of this, long-term versus short-term. In 2014, when the fund was formed, what was very clear to us, to succeed in disruption investing, you require balance sheets, you require scale, you require profitability, and you require cash flows. Those are the things which most of the times the long-term trend companies have, not the short-term ones. The short-term companies a lot of times don't have revenue, they don't have profitability, they could have cash flow issues. So what we did from day one was we allocated lots of our capital, or most of our capital, towards those long-term trends. But what we said, do we leave money on the table? What do I mean by that? If I've done all the work over these years on a long-term trend, and I understand that trend very well, I understand what the building blocks of that trend are, if something comes in those areas which are short-term in nature, should I benefit from that or not? I would love to benefit from that. That's my work. So yes, we do invest in short-term fads as well, but that's always going to be extremely small part of the portfolio.
Can you give us an example of one of those short-term fads that you invested on that was kind of rooted off a long-term trend?
Yeah, I think we were investing in smartphones at a point, and we entered BlackBerry.
Oh, right, okay.
Stock went from $4 to $28 in a matter of 1 or 2 months. So that was a short-term fad. We got out at, I think, $16 or $18, made money for our clients. Thesis was quite simple. Cybersecurity was becoming more important. They were making the right sound at that point in time. Stock was extremely sold off at that point in time. To us, that made sense that the stock should be around $6 to $7, not... I think it ended up at $28 at a point. We were able to exit at $17, $18. So, but the benefit is when you're doing the work on long-term trends, you are aware where the market is, what could work, what can't work in this market. That's just the benefit of being in the market all the time and understanding what could really make the market excited about some stuff.
Yeah. So you said when you started the fund in 2014, there were 5 trends.
Yes.
Have you added any more recently? Are there any where you think you're out in front of people that you can share with us?
So 5 are still there because those were the guiding areas for us, that these are the areas where we expect the maximum disruption to happen over the next 5 to 10 years. The one which we always struggled with has been life sciences, which we didn't have it initially because we were really finding it difficult to invest in life sciences due to the lack of expertise we had. Then we went on to hire someone on our expert panel. He's a PhD in genomics, so we're like, okay, now we can go and do the research on life sciences, and we were able to add life sciences. So there are 6 now. life sciences being the latest one.
Yeah, okay.
Yep.
And then the second part of your philosophy was that the market is often slow to realize the scale of these changes. We might see that something's happening, but we might not realize just how big it would be. Can you illustrate that with an example?
There are a lot of examples I can give. Let's just think about Nvidia, right? We entered Nvidia in 2016. That was 75 cents the stock. It's close to $200 right now. When we entered, it was very clear to us that GPUs are getting more and more share in the data centers. And then came a point, obviously, we were going to ARM conferences. ARM is another technology which you use in smartphones. We obviously understood what Intel does on the CPU side of things, on x86 side of things. What was becoming very clear to us as the data sets are increasing, the CPUs can't really process that kind of data. Mm-hmm. CPUs are core-based. At a given point in time, you can do 8 or 16 process at one point in time. What the world required at that point in time was multiple parallel processing to be happened, and only GPUs provide that. In case of GPU, you divide a task and you divide it into 1,000 tasks, and you're able to do it simultaneously. In case of CPU, you got to wait for one task to finish for the next task to start. So it was becoming very evident to us that the kind of data which the world is generating right now will require a GPU solution. So that was the kind of long-term trend which we played with as we started seeing data center becoming bigger and bigger part of Nvidia, and then came generative AI, and we all know what. But even before generative AI came, I think that stock was it was a 10-bagger for us. Again, we are very valuation focused. We were in out of that stock 3 or 4 times.
Nvidia, yeah,
depending on what the valuation of the stock.
Where are you on Nvidia now?
We are gone heavier into it in the recent correction.
Okay.
If you look at what they're delivering over the next 12 months, they are kind of guided for $350 billion of revenue over the next 14 months. If you start putting that in your numbers, you will see an EPS of close to $8. The stock is trading at almost the market multiple, and it's growing its earnings at about 60% next year. So there's a disconnect there. I think market doesn't believe that AI has legs to it.
Yeah, that's the
market is concerned that there won't be enough revenue in the market to cover the capex which is going in.
Yeah.
We have seen that a lot of times before. I still remember Amazon, every earning after earning, the question used to be, they're building these many warehouses. Why don't they stop building the warehouses? And they can get better margins. And Amazon was saying, well, I want to build these more and more warehouses because that's going to give me a much bigger ecosystem. And once I have that ecosystem, I'll stop building.
I guess the difference in that analogy is that people weren't questioning e-commerce. They knew the customers were there.
Yeah.
People are questioning, I guess, is the
customers are there
end customer for AI, how much are they willing to spend, and are they there? So how do you get comfortable with that side of it?
So I think it's never the case that things are binary or they are black and white on day one when you go invest in long-term trends. It's a gray area. By the time it becomes a black area and not a black area, but by the time it becomes a clear outcome, the market has already priced for that stock. So the data points which give us comfort are, if you look at OpenAI, which is one of the biggest clients of these data centers, it's already projecting a $20 billion revenue this year, ARR by end of this year. By 2030, their projection is they'll be doing close to $210 billion of revenue. If you look at their revenue profile, if you look at their spend profile, as of now, what they're forecasting is close to $110 billion of cash burn over the next 2 to 3 years. That's not $1 trillion. It's $110 billion. In scheme of things where we are right now, that's not that big. That's not what's going to create issues. Secondly, what we have seen this time around on AI side of things is I haven't come across a single person whom I go and talk to and he or she tells me that what I just did on ChatGPT or Gemini did not add value to what I do. It is adding value. It is generating productivity. Third thing which looks very interesting to us is OpenAI is about to reach, I think it's already 800 million weekly subscribers. They're talking about that going to close to 1 billion by end of the year. Historically, I haven't come across a single ecosystem in the world which had those many subscribers or active users and haven't been able to monetize. For OpenAI, there are so many areas they can monetize from. They can start an advertising model. They can start a subscription model. They can start a software model. They can offer their data center services to someone. They're already doing work with John Ives on doing a consumer hardware device. These all are $500 billion plus markets to be disrupted. So for us, time will tell what's happening. At this point in time, compute is constrained. Memory is constrained, networking equipment is constrained, TSMC, the fabricator, is running on full capacity. So all those are pointing to us that this demand is real for the next 12 to 18 months. And let's see what happens beyond that as the time progresses. No one is going to invest if they're not getting return on investment for too long.
Love it. If we go back to your philosophy, I think, looking at companies on the cutting edge of disruption who are fast growing and changing the world, you're not the only fund manager who's looking in that space. To your credit, you're outperforming a lot of your peers who are trying to do that.
Yep.
What do you attribute that to? Like, where do you see your investment edge over your peers?
Is the process. I think investment edge is our standardized process. That process has been designed to ask very clear questions. Or I say it's been designed to ask the right questions with people with 3 to 5 years kind of time horizon in mind. It's not a myopic process. It's a process which lets you think 2 to 5 years out and then model those companies, thinking what the markets could be 3 to 5 years out, rather than assuming that 2 years from now, this market will be a mature market and it's going to mean revert. What we say is, if it's an expanding market, let's go 2 to 5 years out. Let's really try to understand what is a realistic market size here, rather than saying that the super growth stops in 2 years from now. So that's one part, that standardized process. Everyone in the firm knows that's the process we will follow. That's our anchoring point when things fall. That's our anchoring point when things are increasing or prices are going up, and we exit the stock and leave money on the table. And the second part is, Loftus Peak is a single strategy focused fund manager. We have an investment team of 8. Day in, day out, all we do is investing in disruption. What we're looking into is disruptive business models and disruptive solutions. So that's I think is the edge, and that has helped us a lot. That's the DNA of the firm.
So if your process is your edge, I'd love to dig more into your process and really understand, those questions that you're asking and how you take an idea through that process to an investment decision. So maybe if you can illustrate it with an example.
Most difficult part always is idea generation.
Okay.
So maybe I'll give you an example of idea generation, but it might be easier for me to just go through a standardized process first, to just explain you very quickly what the process is.
Yeah.
And
Well,
then I'll spend time on the idea generation.
Yeah, that'd be great.
So the process is a typical upside down pyramid for us, which essentially is we have the 5 areas I talked about, now 6 areas. Everyone in the investment team knows these are the 6 areas we're looking for. We are trying to get access into these 6 areas. With that as a mandate, we go out to the world. When I say we go out to the world, we go to conferences, which are the investor conferences. We go and talk to a lot of companies, so the managements of the companies and the IRs. But what we also then do is we read a lot of blogs, we listen to a lot of podcasts, we read a lot of white papers, and then the most important part is we go to industry events, which are not investor focused. That's what I was talking about earlier. CES, Mobile World Congress, Hot Chips, that are the kind of things we are going, trying to get an edge over the understanding which the market has on a particular area. That's the idea generation stage. When we do that, we come across a lot of companies and we start doing our work. It's not like a traditional fund manager where I can run a Bloomberg screen based on a price to earning or return on investment or return on equity kind of screen and get my names and do the work on that. We have to create our own universe. With those 6 areas in mind, we go out to the world, we create our own universe of about 250 stocks. Then on those 250 stocks, we run a qualitative screen. There's no quant involved yet. What we're doing in the qualitative screen is we're trying to understand, is this a pure beneficiary to the theme I want to invest in? Giving an example there, we wanted to invest in streaming. The question was, should I invest in Disney or should I invest in Netflix? It was very clear to us that Disney is a cannibalization story. For every subscriber Disney gains, they'll have to cut a cord at the back. Yeah. So they're not new subscribers for them. Whereas Netflix is a pure play for us, pure streaming play for us. The other things we look at is the ESG risk. If it's a very high ESG risk company, we want to invest in that. And then the third things which we try to understand is what is the competitive landscape of that particular company. Because when you do that, you also come across more companies which you want to invest in. With those qualitative screens, we mostly will end up with about 120 stocks, on which then we run our DCF models. We don't do price to earnings. DCF is, or discounted cash flow models, are the way we do our modeling. And the reason for that is we want to think how things would be 2 to 5 years out. The way we have standardized everything, we have divided everything into 5 buckets, and all those buckets have their characteristics in terms of top line growth rate, gross margin, cash flows, balance sheets, and management. So all these companies would fall in those 5 buckets. From those 120 stocks, we will end up with 60 stocks, which we call the portfolio stocks. Then from those 60 stocks, or we call them investable universe stocks. From those 60 stocks, we will end up with 30 stocks in the portfolio, 30 on the bench, 30 on which we go and invest in. That is how we arrive to a portfolio. Within the portfolio, what we do, we go back to the thing we raised earlier, long-term trends versus short-term trends. Quality bias is quite big in the fund. 80% of the fund would be core stocks. Core stock tends to be a 5% position. And about 20% would be non-core stock. Non-core tends to be a 2% position. Non-core is where you'll see more risk. That would include some short-term trends, but a lot of times they would still be long-term trends, but they might be going into a new industry and trying to prove themselves. They might have balance sheet issues, whereas the 80% is going to be quality bias. So that's how we do the whole from idea to a portfolio construction part of thing. What we do at Loftus very different is we like to allocate a lot of our capital towards stocks which have a lower upside.
Oh, interesting. Okay.
These core stocks won't go up 10 times.
Yeah.
These core stocks, the highest weight in the portfolio, we are looking for a 30-40% return on that stock. Like at this point in time, the two biggest stocks in the portfolio are TSMC and Nvidia. I'm not expecting these stocks to go 5 times up from here.
Yeah.
We are looking for 30-40% upside on these stocks on a growth rate, which we think is highly achievable. From biggest weight to things which have got the highest, which has got the lowest upside with the highest certainty of achieving them. Lower weight towards things which have got massive upside, but also a high execution risk. Things could go so wrong in those stocks. So that's non-core part where we are looking for a massive increase in the value. Core part is where you're looking for a lower increase, but you're allocating more capital, so you're generating alpha. If you do attribution on our fund, what you'll see is a lot of our returns have been generated from that core part of the portfolio. Higher allocation towards quality companies. Now, on the example, very quickly talking about the idea generation, I'll give you an idea which came to us, I think, pretty much since the starting or 2015, 2016, which it gained more traction. We are pretty much the only fund manager in the whole world, not just Australia, who have had more than 25% weight to semiconductor companies for more than 7 to 8 years. Semiconductors did not come to us last year. We have been investing in heavily some of our last 7 to 8 years. I've been covering semis since 2007. Stuart Kennedy has been covering it since the year 2000. So we had a lot of know-how on semiconductors. But what was happening in those 6 areas I talked about, or 5 areas initially, every time we were doing the work on that, chips were coming up.
Yeah, okay. Yep.
Like, okay, chips are required. And what we were seeing is the projections for the semiconductor industry were that is a cyclical market and there's a limit to how big it goes and it grows at a GDP growth rate. And what we were seeing that we are actually heading into a massive secular growth in these markets. Yes, there is a cyclical part to the semiconductor industry, which is smartphones, computers, and your consumer electronics. But you had data centers, IoT, you had communication services, and now you have AI, and you have automobile. All of them are secular trend stories. So for us, that was becoming very evident. To channel check that, we went to all the areas I talked about. We went to Switzerland, China. We went to US to a lot of conferences asking those questions. And it became very evident to us that there's a secular trend here, that there's a massive mispricing happening in this market. Actually, semiconductors is the cheapest way of getting access to a lot of the disruption the world is seeing. With that, all that work, we ended up with close to 12 stocks in the portfolio in the semiconductor.
Yeah, wow.
Much earlier than market didn't even know what Nvidia was. So if I look at my portfolio back in 2020, I think I was looking at 12 names in the portfolio.
Yeah, okay.
So we had names in compute, we had names in memory, we had names in network, we had names in fabrication, we had names in US, in Japan, in Korea, in Taiwan. So that's what the process is all about. It's about this idea generation and then doing the work on those ideas and then setting yourself up, waiting for the markets to catch up to them.
Yeah. I mean, that's probably a good example to dwell on for a second, because in many ways the market has caught up. You know, Nvidia, TSMC, SK Hynix, ASML, like these companies are all, you know, they weren't known, or a lot of them weren't known 5 years ago in the general investing public. Now they're all sort of household names, at least in investing households. Once the market starts to catch up to your thesis, how do you then think about continuing to hold those positions versus getting out?
Everything is based on valuations. The point specific to semiconductors I'll make is If a firm doesn't have a DNA of understanding semiconductors, and it's suddenly they are going into semiconductors, they can't get 10 years of understanding in 1 year. It's not going to happen that way. There are still cyclical paths to this semiconductor industry, and we'll see how that rolls in terms of do the other fund managers keep on holding to names which are cyclical in nature, not realizing they're cyclical. We'll see how that rolls. So there's a lot of know-how in semiconductors to understand where to invest. And we are still finding a lot of value in areas where we think investors still haven't caught up.
Can you share what those areas?
If you think about networking, a company we invested in Arista, the company is providing, think about Ethernet, which is going into the data centers and connecting each and every data centers. Scale up, scale across, how are you doing amongst the data centers. So that's an area we think has massive growth to it. We understand what the pipelines there are. Within memory, something very interesting is happening, and it actually took us by surprise as well, but we were able to react very quickly. If you remember those old hard disk drives which used to be in your computers, these hard disk drives which used to roll all the time and used to get really hot, and you used to put a fan there.
The fan would get dust in it and it would be really loud.
That was a dead industry, right? It was because that was being taken over by the NAND flash. Suddenly what has happened is because of the amount of data the world is generating, these big data centers, due to AI compute which is going on, they are going and storing their stuff on those hard disk drives.
Okay.
Those hard disk drives haven't had any capacity addition over the last 5-10 years because they were in declining sunset industry. Suddenly that industry is going through the roof right now. So those are the things which you gain as you progress in a particular area when you expertise there. So, but again, everything has to be brought back to valuation. We have standardized process on valuation. Every week what we do is all those 60 names I talked about, 30 which we have in the portfolio, 30 on the bench, we have the fair values which we do on quarterly basis. We assess those companies against their fair values. If the price of those companies are ahead of the fair value, the investment team sits together and we discuss where it is in that cycle. Do we have to exit? Do we have to change the valuation of this company because it's doing better than what we thought in terms of the revenue and earning profile? Or do we have to penalize this company because it's doing worse, because it's not delivering on what it has promised? So we are doing that analysis on a weekly basis, trying to understand why a particular stock is moving. And that core and non-core I talked about, there are times when we make a non-core company go core by reducing a discount rate. Nvidia was a non-core 2% stock. TSMC was a non-core 2% stock, and Netflix was a 2% stock, non-core names in the portfolio, which went on to become core stocks in the portfolio. Baidu, Alibaba, Tencent, 2017, 2018 were core stocks in the fund. They went on to become non-core as we started seeing that there's a regulatory crackdown going on in China, and we have to penalize these companies. So that's how that process works.
Let's hold on China for a second, because the next question I was going to ask you was, how often do you actually go back and assess the 6 big themes and question the assumptions and assess like whether they're tracking as you would? And China's probably a good example for that, because the structural bull case for China, there still feeds into that thesis, and there's a lot to still like about China. But over the years, there's certainly been moments where you would start to question it, you know, like the regulatory crackdowns and what does that mean for investors, the property crisis and what does that mean for investors. These days, we're hearing a lot about the demographic challenges. So maybe using China as an example, how often and I guess how do you go back to those 6 themes?
Those 6 themes are in continuous research all the time. There's everything which happens to any of those 6 areas is marginal for us because we've been following them for almost 2 decades now or 15 years now. So a lot of things don't come as a surprise to us. Those things, the data points are available to see what is about to come. In case of China, we had to exit China altogether in 2018. So yes, we are assessing it on day-to-day basis. What we did was we had an 18% allocation to China, and mainly that allocation was on the thesis that a growing middle class means more consumption, and the companies to get best access to that would be things like Baidu, Alibaba, Tencent, JD of the world. As the regulatory crackdown started, it became very evident to us that first we have to increase the discount rate on China. What we do is, if a company is in US, it might be a 9% discount rate for a growth rate. That company will be 11% discount rate if it's China. That was back in 2018. As soon as the regulatory crackdown started, we said this company has to be discounted at 15% now due to the China risk. And that made it went from core to non-core stocks. So 5% to 2% weight straight away. And then as those headwinds did not really decrease, that they actually intensified, it was clear to us we can't invest. This is not equity or capitalist market to be invested in anymore. This is pretty much driven by government. We have no understanding of the government. But in the recent, let's say 1 year, what we have felt is the environment in China has improved a lot to go back into China. What we are doing this time around is, I won't get too much into that, but we're investing in China for export stories. We are not investing in China for domestic stories. There are companies in there which we are investing in which are doing fine domestically, but now they have become the biggest exporter in particular areas. And so what we are saying is, these are the champions of China, which China wants to show to the world outside. And these companies are winning in the outside world right now. So that's what we continuously keep on assessing. Everything has to be quantified and risk adjusted. I don't think having a blanket ban on anything really works. What you should be doing as an investor is, how can I quantify at what point I can say that this particular investment is investable with all these risks because it has been discounted so severely by now.
Yeah. How do you account for like the unpredictability of government regulation in China?
You do that by putting a higher discount rate. So in other words, what I'm saying is, I think a lot of people think about price to earning. Let's say you're willing to pay 15 times price to earning for something. If it's in China, pay 8 times price to earning. Say that 8 times, I'm happy to take this regulatory risk. At 15 times, I don't think it is at par with the company which is in US. But at 8 times, yes, it has been discounted for whatever the Chinese government can do. Because obviously, our job as an equity investor always is valuations. And I think there are risks to everything we invest in. The question is, how do we quantify that risk? And in case of China, if you are concerned about regulatory risk, pay a lower price for that.
Yeah. Well, I'd love to get to a couple of recent changes in your fund.
Yeah.
And if you could share one company that you've added to the fund, and obviously I'm curious as to what the company is, but I think I'm more interested in how you got to adding it in the fund. Like what changed about the company or about the world that led to that decision that it was time to add it to the fund?
Let's stick to China then, I guess. What we are seeing in China and the export story I talked about, something is happening in the EV space. EV has been a big part of talks for almost 10 years now, Tesla being the poster child there. What has happened in China, I think, or in the EV space generally is, we think EV space has reached an intersection point where the cost and the technology curves are meeting, and we are about to hit an inflection there.
Okay.
China is already at about 60% penetration. I think 45 was the last numbers. They're heading towards a 60% penetration on EVs right now. That essentially means pretty much a lot of the new cars are all EVs. With the cost at which those cars are getting manufactured and the scale they're getting manufactured and the technology, when I say technology, what you're seeing right now, anxiety is a thing of past. You're getting battery technology out of China right now, which is able to charge a battery in about 5 minutes and give you a range of about 450 to 520 kilometers. Infrastructure is not there yet. Technology is there, and they have proven that. Once you start getting to that kind of technological advancements, and this thing is at par with the petrol and diesel cars or lower now, you have to try to understand what the investment implication of that is. And for us, the investment implication of that essentially is, we are heading into a world where penetration of EVs is about to expand very quickly. The projections are by 2030, we will have close to 40 to 45%. I think it's actually close to 50% penetration of EVs in the passenger car market. The company we have gone into in China is CATL. The reason we have gone into CATL is, if you look at the profitability of CATL right now, it is about 90% of the whole battery market's profitability is with CATL right now. That's first thing. Now let's talk about quality. The way you assess the quality of a particular battery is, if a battery goes into a car, how much of that, how many of those cars come back with a warranty claim saying that these batteries were faulty. In case of CATL, that's 0.3% of its sales, the warranty cost. Its nearest competitor is LG. LG has 3% as its warranty cost right now. So the quality is working for CATL. So this is at scale player with the best technology in the world and the biggest profitability, and the valuations are making all the sense to us. So that has been a good addition to the fund. Stock has done really well for us. I think it's up 60% from the point we entered back in May. So yeah, that's an area we are going bigger into.
Love it. So I'd love to ask the flip side of that question now, which is a company that you've sold recently, and similar question, what changed about the company or about the world that led to you selling it?
A lot of time, the exit decisions for the fund would be based on the valuations. What come to mind is CrowdStrike, which we had to exit. It went through our price targets. That's one company. Another company which we had to exit was On Semiconductors. That's a company which is more of a cyclical play. And with interest rates and with inflation scare and with how China is doing on the automobile side of things were looking a bit difficult for that company as well. So those are two names which we exit. One was due to price target, other one because it was cyclical in nature and we think the cyclical recovery has been delayed.
All right, Anshu, I'm going to take a quick break to say a massive thank you to Viola Private Wealth. We're spending this whole series talking about who's the best of the best. But here's the thing. Most investors can't just pick one. That's where Viola Private Wealth comes in. They're like the selectors, building the dream team, taking the best from different markets and asset classes to create something that actually works for your life. Whether you've just sold a business or are looking to diversify away from a traditional property portfolio, they'll help you build a strategy that makes sense for you. Managing significant wealth should not feel overwhelming. With Viola Private Wealth, you will find guidance that is personal, practical, and results-driven. Learn more at violaprivatewealth.com.au. Well, Anshu, I want to move to the market as it is today, and I guess we've just gone through a pretty wild 12 months. How would you sum up the year that was, and where does your mind really go in terms of like the important things for investors to, I guess, keep in mind as we go into 2026?
We are a 3 to 5 years kind of time frame fund manager. Some of the areas over the next 3 to 5 years which I'm really quite positive about are, I think AI continues. What happens in AI, you have to understand the life cycle of everything you invest in. The way we understand the life cycle of a lot of things is we divide them into tools, enablers, and beneficiaries. You'll have to understand in the life cycle where do you want to invest at what point in time. There's a point in which you want to invest in tools, those are the chips. Yep. There's a point when you want to invest in enablers, either the data centers like Microsoft or Amazon or Google. And then there are the beneficiaries. These are real world companies which are benefiting from what has been done. You'll have to assess that as you progress over the next 2 to 3 years. That's one area I'm really positive on. EVs, I think we are at an inflection point. I'm quite positive on EVs and I want to be invested there. And third is life sciences. On life sciences, specifically GLP drugs, we think next year is a big year because the orals are about to come.
Yeah.
And as that comes, we think the market is going to open up. It's not going to be just about obesity and diabetes. There are much more implications which the GLP drugs going to have on the market size.
Yeah.
So those are 3 areas we want to invest in. But specifically 2026, I'm an active fund manager. I have views and I change those views as the time progresses. At this time, the world looks like interest rate are decreasing. But if that world changes, you'll have implications and you'll have to change your portfolio very quickly.
I'm gonna come back to Eli Lilly. I don't want to forget that. But just on the interest rate point there, you mentioned how much are you thinking about those sort of interest rate decisions and the inflation story? How much does that change your day to day?
It changes that part which you talked about earlier, long term versus short term. If you are heading into interest rate decrease environment, what you tend to see is those risk on names start participating in the rally. As at this point in time, if you look at our portfolio, about 96% of the companies in the portfolio are cash flow positive and about 90% of the companies are profitable, gap profitable. If you head into a risk on rally, you will see that possibly those profitability companies will go back down to 85. So we'll participate a bit more there. So that's how we are thinking about interest rates and where the market and the inflation is. If we see that inflation is back in the market and interest rate cuts are not happening, we'll go and stick to our core names because we've done the valuations, we anchor to those valuations. Everything we invest in is secular in nature. What you see with secular things is they don't really get those headwinds which come with inflation and with interest rates because they're not going to the market for funding. They have very well diversified businesses which are in expanding markets. They're not in mature markets. So we go back to those core names and we allocate more money towards those core names.
Yeah. Let's pick up GLP-1 drugs. Yeah. So looking at your portfolio, Eli Lilly is one of the biggest holdings. Yeah. And I guess a big conversation at Equity Mates this year has been Eli Lilly and Novo Nordisk and Novo Nordisk's absolute fall off. I think down 50%.
Yep.
How do you assess the state of the race between the two, and where do you think fortunes are going to go for both of the companies?
We are invested in Lilly.
Yeah.
We still like it. Obviously, I think Novo Nordisk is getting very attractive.
Yeah.
We don't own it right now. On Lilly, we think the biggest thing which is going to happen in the next 12 to 18 months possibly is they already have piled up oral tablets or oral drugs for...
Oh, they've already started
They've already
producing them.
manufactured it. That capacity is there. Once they get the approval, it's going to hit the ground running.
Jeez, that's interesting.
It's just going to change everything.
Yeah, okay. So they're very confident that they're going to get the approval. And
They are. And also, from our understanding, the way they do the orals is much easier than the way Novo Nordisk is doing.
Way easier.
The production part, because Novo Nordisk is going to do it much more live. It's still using it's bigger peptides, whereas what Lilly is doing is much more simpler, and it's going to be easier to scale up on that. So that's looking very positive also on Lilly right now, and hence obviously stock has gone through $1,000. It would be right to assume we are trimming. So yeah, I think we've done well out of the stock. Happy with it.
Yeah. It's been a really interesting investing lesson for us. Because you can be right on the big structural theme, GLP-1 penetration is going to increase, this drug actually works, it has, massive health benefits for people. And I think I saw a stat out of the US that penetration is now in double digits, 12% of American adults have tried GLP-1s or something like that. And so the big structural trend is right, but obviously the fortunes of these two companies diverged in such a big way.
Yeah.
You were on the right side of the trade with Eli Lilly. What can we learn from that going forward in terms of translating the big macro thesis that you write about to actually finding the right names to play
I think
that theme?
that's a very good question. So first, being right on the macro thesis or on a bigger picture thesis, I think that's a very good place to start from. That gives you a margin of safety as compared to going to those short-term fads, because they don't have those structural themes pushing them. It's a very company-specific niche. At least if you're right side of the trade in terms of understanding this is an area which will grow much faster than the GDP, and I want to participate in that. From there on, I think it's going to come down to industry analysis, and if your stock is going wrong, be open. Be open to change. We do that all the time. If I go wrong on something, if my thesis is wrong, the investment team, we challenge that all the time.
Yeah.
There's no ego in this. This is a very fast-moving world. Things are changing by a matter of weeks and months right now. You could be wrong at things. Accept it and change the portfolio.
Yeah. So I want to move to a couple of final bits of advice, and then I've got a rapid fire game to close it out.
Right.
We've been talking about big structural trends, and I guess that's what Loftus Peak has really been founded on, those 5 and now 6 themes. But if I was to make you pin your colors to just one big theme, one theme or structural trend that you believe will define the next 10 years, which one are you choosing and why?
It's going to be all of the 6, but the way I put it is, I think it's going to be the first part of our philosophy, which I talked about. We continue to believe disruption will become a bigger part of the market. So to give you an example, 2014 when we launched the fund, the top 10 companies of the world were about 8% of the market. Now, if you look at 2024 June, you were looking at about 23% of the market are top 10 companies. And those top 10 of 2014 to 2024, there have been 7 new names added. All these 7 names are disruptive companies, and they have had massive increase in their valuations. So if you wanted to outperform the global market in the last 10 years, you had to participate in the disruptive companies. So my belief is, and other firms' belief is, that's why this business exists, is that disruption will keep on getting bigger and bigger part of the market. It will keep on rolling through all the sectors. So what you got to look at is be open to is the change the world is going through, and try to analyze that. So that's
Love
my
that. Yeah. I mean, it's exciting. I love it. This is a reminder of why I love investing. It's people think about investing as this finance exercise, and it is. You have to be across the finances, but it's about how the world is changing and the people and the companies that are changing every part of the world around us.
Yeah, I think what I struggle with a lot of time is, I think people go into their new cars these days. They sit in their car and they're like, wow, the technology is through the roof as compared to my previous car, which was 10 years old. And then they think, how would I invest in that? And then that's what we all are feeling around us. This is a car. This has got a lot of technology in it. There's Uber in there, which has just suddenly come out of nowhere compared to taxi, what I was taking earlier. I'm shopping online. So our world is really changing very quickly. And to invest in that world, you'll have to understand that what is a growing market and what is not a growing market, and adjust your portfolio according to the way you're living your life.
Yeah. Well, if you could go back to your 25-year-old self, or you've got kids, maybe if you were talking to your kids and giving them some investing advice, what advice would you give?
Single stock based investing is not investing edge. So I think what I'll say is have a repeatable process which you can go back to day in, day out, so that you can keep on doing investments all through your life and create a portfolio of companies rather than sticking to one stock and thinking that you can consistently keep on picking the best stocks in the world.
Yeah. Love it. Well, Anshu, I said I wanted to finish with a bit of a rapid fire game. I've got a couple of prompts and you just tell me whatever comes to mind for each of them. So what's one stock or asset class you're excited about?
EVs.
Yeah. What's one thing you've changed your mind on recently?
China has become more investable than it was 5 years back.
What's the most underrated investing skill?
Openness to change.
Love that. What's one investing myth you would banish?
Mean reversion. For mean reversion, you require a mean. You don't have mean in rapidly expanding markets because they are not mature yet. So if you have a mean reversion mentality in a rapidly expanding market, you are actually saying that this market is at the peak. So I think that's why I feel like investing in the disruptive space, mean reversion will only happen 10 years from now. Yeah.
Is there a book, podcast, or documentary you'd recommend?
One in the semiconductor space, which if people haven't read yet, is The Chip War by Chris Miller. I think it's worth reading, just trying to understand what's happening in China and US and what happened in Russia. So it's important to understand that because semiconductors are a big part of our life now. On podcasts, we love Stratechery a lot, Ben Thompson. So I think those were two good areas.
That is a good one.
Yeah.
And then finally, if you can finish this sentence for me, great investors.
Great investors have a repeatable investment process.
Love that. Well, Anshu, this has been a great conversation. I've learned a lot and we've spoken about some really interesting companies. So what more can I ask for? Thank you for joining us today on Equity Mates.
It was my pleasure. Thank you.
All right, well, that does it for this episode. Thanks for listening to our Best of the Best series. This episode was brought to you by Viola Private Wealth. Personal, practical advice for managing serious money. Learn more at violaprivatewealth.com.au. Now make sure you're subscribed wherever you're watching or listening so you don't miss our future episodes in this Best of the Best series.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.